Welcome to the world of Test Portfolio XSX. This video was created with the help of artificial intelligence. It provides a weekly summary of key economic events. The featured portfolio is simulated, fictional, and reflects my personal perspective on recent market developments. My main goal is to explore whether the S&P 500 can be outperformed. To do this, I compare the performance of three different portfolios: my own fictional portfolio, an S&P 500 portfolio built using a lump sum investment strategy, and an S&P 500 portfolio built using the dollar cost averaging method. This video reveals which strategy performs best and why. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur. Ready to get started? Let's go. Labor market tremors and Fed panic clouded the week of independence. Tensions ran high in the U.S. markets during the shortened holiday week, and not because of the fireworks. At the beginning of the week, there was still an air of optimism, as the end of June closings painted a strong technical picture. But it quickly became clear that July's opening was built on shakier ground. Let's start with the U.S. labor market. Tuesday's JOLTS report showed a surprising drop in job openings, down to below 7.4 million, a three-year low. The market initially welcomed this, as it signaled a cooling of the overheated job market the Federal Reserve has been monitoring. But the weakness didn't stop there. On Friday, the big highlight of the week arrived, the non-farm payroll data, but since the stock market was closed for Independence Day, the market's actual reaction can only unfold the following week on Monday. However, one thing is already clear from the numbers. The Fed may be forced to cut rates in September not by choice, but because the economy is beginning to tire. Only 132,000 new jobs were created, compared to the expected 190,000. The unemployment rate remained unchanged at 4.1%, but wage growth also stalled. Meanwhile, the Fed's June meeting minutes were released on Wednesday. Policymakers showed strong division behind the latest rate hold. Some cited stagnant inflation, while others already feared a slowdown in growth. This document confirmed the overall picture. The Fed is cornered. It doesn't want to ease, but it's on a forced path. No good news came from China either. The official manufacturing PMI remained below 50 for the sixth consecutive month. Moreover, the unofficial Caixin Index also posted a surprise drop. This had a direct impact on the U.S. tech sector, especially on companies like Apple and Nvidia, which rely heavily on their Chinese sales. The weakness of the Chinese economy acts as a brake on global demand, lowering U.S. export expectations, especially in chip manufacturing and luxury goods. From Europe, this time Germany's inflation data impacted U.S. bond yields. The lower-than-expected German CPI pushed European yields downward, which indirectly led to a stronger dollar, and that weakened U.S. exporter stocks, especially in aerospace and the industrial sector. On the commodity market, oil prices rose. Brent returned above $89 after Libya announced that it was halting operations at two key oil ports due to political unrest. This pushed shares in U.S. energy companies upward, but only temporarily. Global growth fears later crushed buying appetite. At the beginning of the week, the indexes were still in the green. The S&P 500 started Monday at 5,544 points, but dropped to 5,472 by Friday, a 1.3% decrease. The Nasdaq followed a similar path, falling from 18,300 to around 17,860, mainly due to the weak performance of the tech sector. The Dow Jones, however, remained relatively stable thanks to the temporary outperformance of the energy sector and traditional industrial stocks. By sector, the week's winner was utilities. Defensive investors started accumulating them as a safe haven. On the other hand, the losing side was led by semiconductor manufacturers, headed by AMD, which fell 7% due to weak Chinese outlook and fading AI optimism. This week also showed how quickly market sentiment can shift. The first half of the year was marked by tech euphoria, but in July more and more cracks are showing. The Fed doesn't want to cut rates, but it may no longer have a choice. China can't manage to jumpstart its economy, dragging down American growth hopes. Geopolitical risks, Libya, Ukraine, Taiwan, are strongly creeping back into asset prices. Question to you: do you think the Fed's September rate cut will bring a positive turning point in the markets? Or will it rather be an admission that something is already broken? If you're curious how this affects my fictional portfolio and how I respond, check out the next chapter, or hit subscribe so you don't miss next week's story. Which moved the market more this week? A cloud services giant or an EV maker's production report? Let's take a look at which earnings reports defied expectations and how the stock market responded. Oracle, one of the world's largest enterprise database and cloud service providers, quarterly EPS, $1.70, exceeding analyst consensus of $1.64. Revenue grew 11% year-over-year to $15.9 billion. The cloud segment stood out with 52% growth, indicating that Oracle is well-positioned in the shift toward AI-driven demand. The stock reacted positively, closing the week nearly plus 5% higher. Tesla, the global leader in electric vehicles. The company released Q2 production data. 384,122 vehicles produced, down 11% year-over-year. Yet the market reacted optimistically. Shares surged over plus 6% on July 2nd. Why? Investors are focused on the future, especially speculation surrounding the robotaxi announcement, and the fact that the decline was smaller than feared. Speculative sentiment outweighed the negative production figures. Progress Software, PRGS, a smaller but steadily growing enterprise software provider. This quarter's EPS was $1.01, 16% higher than the prior year, and again beating analyst expectations. This marks the fourth consecutive earnings surprise, reinforcing investor confidence. The stock gained plus 3.8% accordingly. Constellation Brands, STZ, maker of Corona and Modelo beers, a major player in the alcoholic beverage market. On July 1st, they released their Q1 financial report. Analysts expected EPS of around $1.01. Market focus was on premium product sales and potential inflationary impacts. The stock movement was muted, minimal change, as investors are waiting to see how summer consumption trends play out. Albertsons Companies, one of the largest U.S. grocery chains, parent company of Safeway, Vons, and others. They held their investor conference on July 1st to present Q1 2025 results. The spotlight was on inflationary pressure, pricing strategy, and the ratio of digital sales. The stock remained flat, with investors waiting to see how competition with Amazon and Walmart evolves in this segment. UniFirst Corporation, U.S.-based company specializing in industrial clothing rental and services. Q3 earnings were released Wednesday morning. Results slightly missed expectations due to slowing corporate orders. The stock fell -2%, but long-term outlook remains largely unchanged. Oracle was the clear winner this week, dominating tech headlines with explosive cloud growth. Tesla's case illustrates how stock prices can soar even when fundamentals disappoint, as long as hope for the future is strong enough. The consumer, industrial, and retail sectors had a neutral week overall. No standout surprises, but no major disappointments either. Which earnings report surprised you the most? Leave a comment, and don't forget to subscribe if you want more weekly earnings recaps like this. My current strategy has worked so far. Buying shares in the semiconductor sector has delivered the expected results. In recent times, it has become clear that one of the biggest winners of the AI and data processing boom are the chip manufacturers. Following this direction, I consciously built the portfolio from companies that directly profit from this trend. The performance so far has confirmed the initial decision. The portfolio has significantly outperformed the S&P 500, and most chip stocks have seen substantial price increases. The extent of the rise is based not only on fundamentals, but also on psychological and narrative factors. Market expectations have raced ahead, and in many cases, profit forecasts for 2026-27 have already been priced in. At the same time, it is important to recognize this is no longer an entry point but an advanced phase. Therefore, as I indicated earlier, we have reached a point where I will reassess the positions. If the current upward trend brings one last surge, I will likely follow it not with new positions but with profit taking. As a result, not only the individual stocks but the full closure of the entire portfolio may also be on the agenda. This approach is not about market timing but about consciously managing the risk-reward ratio. Extreme optimism, market euphoria, and the speed of the rally are making further exposure less and less justified, at least in this sector. What comes next? If it comes to selling, That will mark the beginning of a new target searching phase. So let's see how the three strategies have evolved. Strategy 1. Lump sum, one-time investment blue line on the chart. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals. Current performance year-to-date, 76%. The blue line reflects this result, based on the most recent Friday closing price. Strategy 2. Dollar cost averaging, gradual investment green line on the chart. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance year-to-date, 25%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3. My fictional portfolio red line on the chart. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025 with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance year-to-date, 28%. Note, these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. It can be seen that there is currently little difference between the results of the strategies, but my fictional portfolio with chipmakers is very volatile and dropped significantly on Friday. Which sector do you think will be the winner if you were to invest now? Let's recap how we got here. Test portfolio XXX, red line. After a flat start to June, it suddenly moved sharply higher. From about -2% at the end of May, it climbed steeply to above 10% by mid-June. It delivered the highest return of the three portfolios for the month. Lump sum strategy, S&P 500 benchmark, purple line, also turned positive in June, tracking XXX but more slowly and less dramatically. It sat near -1% at end May and rose gradually to roughly 2.78% in June. Dollar cost averaging, green line, followed a similar upward path. From around -1% at the end of May, it moved toward about 3.61% by June. June trend in one sentence test portfolio, XSX, outperformed decisively, while the other two posted mild but steady gains. XSX's rise was far steeper and faster. Sharp pullback on the Friday, the 13th of June test portfolio, XSX, red line, experienced the largest drop, falling from its mid-month peak above 10% to 7.30%. Lump sum strategy, S&P 500 benchmark, purple line, slipped modestly to 1.62%. Dollar cost averaging, green line, also corrected slightly to 2.46%. In the chart from June 13, 2025, we observe the following. The test portfolio, XSX, red line. This portfolio shows a very strong upward trend. Around June 13, 2025, the performance of the XSX portfolio fluctuated around 7.30%. After that, it undergoes a significant rise, reaching nearly 10% by mid-June, then jumps dramatically to over 21% by the end of June. This indicates that the second half of June 2025 was a period of significant gains for the test portfolio XSX. S&P 500 dollar cost averaging, shown by the green line, represents a second S&P 500 reference. From June 13, 2025, this line is generally positive but shows a more moderate upward trend. It displays steady but not spectacular growth. S&P 500 benchmark lump sum, represented by the blue line, is the main S&P 500 benchmark. Similar to the green line, the blue line also shows a positive but more moderate upward trend starting from June 13th. The green and blue lines closely follow each other, suggesting that both represent the S&P 500 or very similar broad market indices. Summary of performance starting from June 13, 2025. The most striking observation is the outperformance of the test portfolio XSX, shown by the red line, compared to both S&P 500 benchmarks during this period. While the S&P 500 benchmarks show a stable, approximately 7% positive return by the end of June, the test portfolio XSX experienced a significant increase, producing returns well above 20% by the end of the month. This suggests that whatever strategies or assets were included in the test portfolio XSX resulted in exceptional returns in the second half of June 2025, significantly outperforming the general market represented by the S&P 500. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.